Hello and welcome to our viewers on cruxinvestor.com and also our listeners to Cruxcast. We're going to be speaking with Anthony Milewski. He's the CEO of Cobalt 27. How are you, Anthony?
Hey, thanks for having me. I'm great.
Well, thanks for joining us.
Yeah.
Why don't we kick off and kind of set the scene for everyone? Give us a 2-minute overview of Cobalt 27.
Yeah, so when I think about Cobalt 27, I want to step back and really start to think about the world. And what we're seeing today is a structural change in two of the most important industries in the world, namely the energy business and the automobile industry. So if you think about crude oil today, something like 60% is used in transportation, maybe even more, 60. If you think about the automobile industry and what's happening there, you're seeing almost every automaker in the world transitioning into electric vehicles and hybrids. You're seeing autonomous vehicles and the rise of the autonomous vehicle sort of any day now coming. I don't know if you would have noticed in the last kind of week, Tesla announced 1 million of these vehicles in the next year. I don't know if they'll hit that target, but you're seeing massive disruption. And when we set out to create Cobalt 27, we were thinking about how do you capture that disruption as an investor? Like, what is the best way? And what we realized was it's tremendously challenging because while we can all agree that these changes are coming and you can't really stop them, what we weren't able to kind of nail down was how do you play? Like, do you buy Tesla stock? I don't know. Maybe actually Ford is going to be the winner. Potentially Beijing Auto. I don't know. Maybe you should buy NVIDIA, the chip maker. Maybe you buy one of the sensor makers. And then we realized something, which is so long as you believe that there's going to be a winner, so long as you believe that there are going to be electric vehicles sold, the winner is actually basic materials. And the reason is because every single electric vehicle, every single hybrid is going to have a battery. And that battery is a lithium-ion battery that has lithium, nickel, cobalt, manganese, these basic materials. And so we set out to create a proxy for the adoption of the electric vehicle, the disruption of the energy industry, and that proxy is really Cobalt 27.
Okay, so I think there's a general acceptance that people are moving towards electric vehicles, batteries, whatever they do, storage for homes, businesses, etc.
Like the Tesla Powerwall.
It's all coming down the line, and there's a lot of information in the marketplace about that. So tell me a little bit about your strategy, because a lot of companies come to us without a business plan.
Yeah.
They've no written business plan, which surprises me, having worked outside of this space. So tell me a bit about your strategy and why you think that's going to give you the edge. Yeah,
so it's very simple. We have copied, in a way, Franco Nevada or Wheaton Precious' business model, which is streams and royalties. We are not miners. We go out and we seek to do streams and royalties with world-class partners. So if you look at the first cobalt stream ever done, we did with Vale. So Vale is a world-class mining operation, right? So they're the operator of the mine. If you look at a transaction that we're in the process of closing, it's a nickel cobalt mine, once again in operation. MCC is the operator. So the business model is very similar to the Francos and Wheatons of the world who focus on precious metals. But what we've said is we're going to replicate that business model, but focus on the battery metals, particular nickel and cobalt, that are absolutely critical to the lithium-ion battery.
But you also have some physical product as well, I notice, and some interest in other battery metals as well. So it's not a sort of pure royalty play, is it?
No, I mean, you have to kind of play the hand you've been dealt, as it were, and because of the specialty nature of cobalt and nickel, we had to be a bit creative. And when we launched the company, we actually launched with approximately 2,000 metric tons of cobalt, and then we bought another 900 tons subsequently, a few months after launch.
Why do that? What are you doing? Hedging?
Well, no. So that was the foundation of the balance sheet. So when you have a physical commodity like that, you can actually take leverage. Right. And in the early days, we wanted to build the balance sheet so that we could do the subsequent transactions like the acquisition of the royalty on Voisey's Bay or the Dumont royalty. So that was really a strategy around building a balance sheet.
So how does that work? You're leveraging that. Why wouldn't you just sell that into the market?
So we haven't used leverage to this point. However, we have a credit facility available to actually leverage it.
There's a couple $100 million.
Yeah, exactly. So why don't we sell it? I think one of the things, so I've talked briefly about the fact that we've replicated the Franco Nevada model. I think one differentiated aspect of our business is we're creating an ethically sourced supply chain. So everything we do is outside of the Congo. And we can talk about it later, but there are a lot of issues around conflict minerals with cobalt in the Congo. And so one of the things in having this physical cobalt position, having the Voisey's-based stream, you have flow of material, as it were, which is all outside of the Congo. So at some future date, if a battery maker, an automobile maker wants to step in and actually take that material, it's another available source. So we sort of see ourselves, in addition to copying the streaming and royalty model, we're actually creating a conflict-free supply chain outside of the Congo.
Okay, I was going to ask you about this later, actually. So explain to people what's going on in the DRC, which makes that problematic for you as an ethical sourcer.
Yeah, so to be very clear, we have zero investments in the Congo, and we've told everyone categorically that we're not going to invest there. That's a very important point.
Right.
But what's going on there is very straightforward. Some of the highest grade copper, some of the highest grade ores actually sit inside of the Congo. And what happened, and has happened for cassiterite, which is tin, and a bunch of other materials over the course of the last 20 years, is that when a given basic materials price gets sufficiently high, it's actually economic for literally an individual to go out there with a shovel, dig up the ore, and put it in a sack and sell it, right? And so, what happened, and has been happening for a long time with cobalt in particular, but a bunch of other metals have suffered the same fate, including copper and cassiterite and tantalum, and is that in these situations where they're very poor, people bring their kids along, and so you have people who are missing school, or you have a family member, a friend who's kind of having this child who might be 10, 12. I think there's some great Wall Street Journal reporting on this, and Global Witness has reported on this. They're having these children out there digging this ore that's ultimately getting put into the supply chain. Where we come in is we're saying, look, we can't fix that problem. I believe people can fix that problem, but we're not unable to fix that problem. And so what we're offering is a product where none of our material touches any of that supply chain. And what we think is, the early adopters of electric vehicles, in particular in like the US and Canada and Europe, I think they're green individuals. Like they care about the environment, and so I think that they care about the supply chain of the materials that comprise that electric vehicle, and they want to know that that their new, name the name of the car, is actually not having conflict cobalt inside of it.
Is this a marketing thing? I mean, are we saying that these companies will find it easier to market a green product?
It's ethical.
Versus,
I know it's ethical.
I know it's ethical, but there's a kind of balance between is it a gimmick for marketers, or is it a genuine concern for these countries?
I think in the companies, I think it's also a legal concern. I mean, if you're, there are there are laws like in the U.S. I'm familiar with. Right. You can't be like. You can be selling a product with known conflict materials. I mean, so you run into legal issues. So I think it's twofold. I think there's just an ethical issue, but I think there's also a legal issue. And look, I do believe that with time, companies are thinking about ways with blockchain and different technology to bag and tag, which is what they did with tin. Meaning, you go all the way back to the source, you put it into a bag that you can verify, then they put a barcode on it. None of these systems are perfect, but none of them properly exist for cobalt yet.
So, you say they're not perfect. So, but who measures or monitors what is and is not ethical? And you say
it doesn't exist. I mean, really. I mean, I think if you're a cathode maker, a battery maker, an automobile maker, at the moment, what you do is you buy directly from large mechanized miners. So you buy from a Glencore or a Vale, because I do believe that those companies are able to look through the supply chain. Right. But I think there's only so much cobalt that's produced by those companies.
Right.
And so as soon as you step into like an aggregator, I think you start to enter a pretty murky space, which we're completely avoiding. And people are making efforts to clean it up. It just will take time.
In Congo.
Well, what they're doing is they're trying to create tracking systems. There's a couple companies trying with blockchain technology to really be able to demonstrate that we're talking about cobalt, but this could be true of any of the materials. Like, look, okay, here's your car, and by the way, here's the manifest, and the cobalt came from here, and it's sort of ethically sourced. But it's a very complex issue, and I'll give you an example. Sure. If you're a refiner or a processor, and you have 15 sources of cobalt, 14 of them may be legitimate, but if the 15 one isn't, it all gets mixed up, and it taints the whole. And the LME, by the way, the London Metals Exchange, they've announced that they're taking steps to try to look back into the supply chain. And so I think people are aware of the issue. It's just very complex, and it's not going to be something that's just sorted out, like that. It's going to take years.
Yeah. Well, and I guess in the meantime, there's always going to be a market for what you're determining is, well, and others are determining as unethical or not green.
Well, I mean, there's always going to be there will be that market, but I can tell you, we spend a lot of time in China. I was in Beijing last week, and there's this kind of idea that the Chinese don't care, and I think that's completely false. I mean, like I can tell you, like we were with a lot of major automakers, battery makers. They're acutely aware of this problem as well,
right.
and they care also. I mean, they in China, and we can talk about this. China is really setting environmental policy globally around the adoption of electric vehicle. The intention there is ultimately not to sell you a battery, but to sell you a car. So you're driving your Beijing auto car in London. Like that's going to be the future, but setting that aside. So they're acutely aware of this problem. And I can tell you that, the Chinese consumers who are making these electric vehicles, they don't want to buy this stuff either. And so the problem isn't like, it's a global problem, I guess is what I'm getting at.
Yeah, I think and we can probably come on to China later because they seem to be leading from the front certainly in the battery space at the moment. So tell me a little bit about you. You come from a financial background. I think you position this as a financial play, what you've constructed here. So tell us a bit about you, how that's informed your thinking and the strategy of the business.
Yeah, so I've spent my career primarily as a resource investor, investing primarily in metals and mining, but also oil and gas to a lesser extent, in Europe and New York. And it has highly informed the business because we really are taking like a risk-adjusted return portfolio approach. We try to dilute concentration risk. We have multiple royalties across a number of jurisdictions.
But all battery metals related?
All really at the moment nickel and cobalt related.
Just those two. Would you really be looking at the other battery metals as well?
Look, I think our investors are primarily interested in that class 1 nickel that goes directly into the chemical industry and cobalt. And so that's the focus. I mean, there are lithium miners, so you can actually go buy a lithium company. And by the way, there are actually a lot of copper miners as well. But cobalt as a byproduct is very hard to invest in. In fact, I don't think there's any real legitimate way.
Right.
And then, the kind of nickel that goes into batteries, once again, it's a harder play. And so we have that focus, and then within that focus, we have this portfolio approach of multiple royalties and streams across multiple jurisdictions. And so in a lot of ways, it's kind of trying to kind of diversify risk such that if one asset, something happened, you sort of don't cause a cataclysmic problem for the business.
So tell me about, royalties is an interesting space. There's not that many players in it. How do you, as an investor in the space, this is a financial product for you, do you have any say in what the company's doing, or are you just looking at the balance sheets each week and going, it's working,
there are each one of the great things about the product is it's very bespoke. So each royalty or stream is addressing a specific concern, a specific situation for that company. But one of the reasons I think why the companies like it is you're not running their business. Right? Like this is their business.
But do you have a say in it?
You definitely don't have a say, but the structure is such that you do have protections. I mean, you have minimum throughput.
Right.
You're covering the entire mine, because like if you, just as by way of example, if you just focused on a little area, you could create an incentive to mine a different part of the mine. So you structure the contract, and remember, the industry's been around for over a decade now, and so people have kind of learned from some of the early mistakes.
Sure.
But what I would say is you're definitely not operating that business, and through the structuring of the contract, you have protections.
Right.
But it's a very hands-off, light touch approach.
So the hard work for you is determining which companies to invest in and structuring the agreement.
Yeah, and also getting them interested, because when you're dealing with a counterparty that is potentially a large miner, there has to be a reason why they want to do it as well.
If they're producing, they've got options, and it's a question of what's the
cost of
them,
capital.
for sure.
Exactly.
All of that kind of good stuff. So what do you spend your time doing then? If you're sitting back looking at numbers, I mean, what's your time spent on doing? Are you looking at M&A opportunities constantly?
Yeah, so we have a list of probably almost every single nickel and cobalt
Right.
project in the world. I mean, legit,
Right.
like it's an Excel document.
Right.
And we track very closely the life cycle, where the companies are at, and then we have kind of a short list of situations. Companies that you may not even realize, I won't say them publicly, but companies that you may not even realize produce nickel or cobalt, and maybe there's a capital expansion announced. Or they're fixing the refinery. You say, well, hold on a second.
Yeah.
They don't even show that there's nickel there, but we know there is. So they're getting no credit for that nickel. So what if we come to them and say, here's $100 million, just by way of example.
Sure.
And then there would be other companies that would be moving along the development kind of timeline. And then there'd be divestitures, and maybe a company's buying another company and they need asset finance, and so they're really buying a nickel project. So there's all these different situations, and we monitor them.
But this isn't about their needs, it's about your needs. So, talking about the structure is like, what are you actually looking for? Are you looking for a quick monetization event, or are you kind of building some, something bigger than that, which when all the parts are put together...
You mean Cobalt 27 specifically, or?
Yeah.
So these contracts are usually life of mine.
Right.
So you're talking about getting product potentially for 30 or 40 years. So this is a business.
Was at your discretion? You can opt out or sell or cash in at some point.
No. The way the agreement works, like take Voice's,
right.
That's the life of mine, or the royalty on Turnigan. That's for that's for what's potentially a 60-year mine life, right? So these are very long duration contracts. And that also makes it attractive, because ultimately, if you're an end consumer of the product, you can have visibility then on the life of this particular mine.
So give me a sense of that. So life of mine, this can be up to 60 years?
Well, in the case of one, in the case of that one particular mine.
What are you averaging?
It's very different,
right.
But I would say by the time people put billions of dollars of capex into something,
right.
I think you're talking 20 to 40 years on a lot of these.
That's right, amazing. And that must make the cost capital for you a lot cheaper.
Yeah, no, of course. I mean, when you pick an asset which is in production or almost in production, the funny thing about finance, as is like if you use a 10% discount rate, after 10 years everything is worth zero. Yeah. But I can tell you we can all agree that's a nonsense, right? So it's sort of the funny thing about the cost of capital and how you look at these investments. Yeah. So you actually have massive upside just because of the nature of a discount rate, which is kind of this esoteric thing, which people don't care about in the short term. Yeah. But as you compound these royalties and streams and you keep adding to the portfolio, you actually ultimately are creating a huge free cash flow scenario in years to come, right?
Well, absolutely. And so actually tell me this. How long have you been with the business?
So my partner and I, Justin Cochran, we took it public about 2 years ago. Right.
Okay. And what was the kind of major moment? Did you get the strategy right from day one, or was there a moment where you thought actually?
It was always the strategy to begin with. Like if you go back and read the prospectus, I think even in the prospectus, although we were focused on that initial physical holding when we went public, even in that initial prospectus, when you read it, you can see that this was always the business plan. I mean, we really, even from the earliest days when we were putting the team together, Justin, he spent, prior to joining us, he was at Sandstorm, which is one of the royalty companies in Canada. And then prior to that, he was a banker at NBF, doing streams and royalties. And so even like the formation of the team was twofold. One was getting the technical industry knowledge, and then the other, of course, was the actual financial knowledge. And so this was always kind of the plan. Right.
So what's it look like going forward? I mean, you're starting to build up a body of work, as it were, a portfolio, which gives you the credibility in the market. I mean, is there a limit to this? How much do you think you can manage? You've got quite a big board, a lot of advisors on there. So
remember that there's a board and there's an advisory board.
Right.
So the advisory board is unpaid advisors who kind of help along the way, but the actual board is kind of just I would say, standard.
Right.
So I think we're kind of at a moment now where Voisey's Bay was closed earlier last year, and Highlands Pacific acquisition closes in May this month.
Yeah.
And it's time now to let sort of the cash flow start coming in and let the share price appreciate.
Right.
We did a lot of capital raising in the first couple of years. We had a lot of price volatility around the commodity.
Right.
And so I think it's time now to let investors kind of reap the benefit of that. And so I don't foresee anything immediate, just because we need to kind of let the stock age here a bit.
Okay, because I guess you're trying to balance or weigh up the opportunities in the marketplace, because the commodity prices, certainly in battery metals, even gold, even uranium, there's a few commodity prices which are suffering, which often says opportunity, especially for companies struggling with cash. So you've got cash, people need cash, and your big spreadsheet must be telling you there's a few people out there, but at the same time you've got these shareholders. You're saying it's important to give
including
them
myself. No,
including
yeah,
yourself, right.
And
what does that mean when you say, we got to look after shareholders now?
Well, no, I mean, like the creation of ultimately, the endeavor is not worth doing if the people who invest in the business aren't making money. I mean, that's fundamentally, you're not going to have support, and it doesn't make sense. So we've been exceptionally active. I mean, we've raised hundreds and hundreds of millions of dollars in the last few years. We've done, I'm unaware of anyone who's done more M&A in terms of deal numbers. And so I think there's just a certain fatigue, and now you have to kind of let these assets settle into the business.
Breathe a bit.
Yeah, I mean, think about it. You know, you have Voisey's Bay, you have Highland Pacific, two premier world-class assets. On the development side, you have Turnagain, the largest nickel sulfide, undeveloped nickel sulfide. You have Dumont. I mean, you start going through that. This has happened in like 2 years.
Yeah.
We raised 300, then we raised 200, we raised 100, we raised 200. So there, a lot has happened in a very short period.
Right.
And it's time now to kind of like digest it.
Right. I get it. That's fantastic.
Yes,
fantastic.
It's just it is what it is.
So we talked about the board a second ago. Tell me about the active members of the board and the management team, people who actually are involved on a day-to-day basis.
So I think on the management side, besides myself, you have Justin Cochran, who, as I described, he's really one of the top streaming guys in the world, and he really joined because he has learned from the good and the bad and the ugly of the streaming industry over the last decade. Yeah. Because it has evolved.
Yeah.
So that's
in what way? What do you mean it's involved?
Like just as a basic example, like in the early days of a stream and royalty, they had terms which might have been so oppressive that if anything went wrong with the mine, it could send it into bankruptcy. So they're just little kind of things like that.
Death spiral type
structures. Exactly. And so it's completely evolved away from that. Or like a basic example could be, if this, let's just use a piece of paper. If this is your mine, and you're only streaming this little portion over here, well, you're creating an incentive for them to mine it over here. So when you create the diagram, you take the whole. So
you are affecting strategy on a company which you shouldn't be running.
Exactly. Right. So the point is, I think the whole industry has learned from these evolutions, as it were.
Right.
And Justin was there through that process, so he kind of brings that really critical knowledge of the underlying document.
Yeah. It's tough being there.
And then the next guy is called Martin Vidra.
Right.
And Martin is a very interesting case. So he was 30 years at Sherritt.
Right. Yeah.
And he worked in, he was at MOA, which is a nickel cobalt mine. He was in the technology group. So he brings a real depth of technical knowledge about nickel and cobalt operations globally.
Right. So he's part of the assessing process.
Yeah, and he's just generally critical. I mean, if he's going to look at a mine or talk about processing, I mean, really, you're talking to Martin. Sort of 30 years of experience there. And interestingly, prior to that, his father was at Sherritt for 20 years. So these guys have the nickel cobalt in their blood. Right. And that's really the core of the team. Right. We also have a director of communications who does that. But the model allows for a very lean operation.
Yeah, I suspect. I mean, your G&A must be next to negligible.
I mean, I can tell you the biggest aspect of the G&A was actually like legal fees and banking fees from all the transaction costs. Right. So actually that goes down quite a bit when you're not transacting. For sure. So you've got a bunch of advisors, which are, I guess, you go to for specific matters. Yeah, exactly. Right. You reach into those advisors. in specific moments based on whatever their expertise is.
Right.
But then you have a traditional board of directors.
Yeah.
And there's a range of skill sets there, like, take Frank Estergaard, chairman of the audit committee. He was a partner at KPMG. So an exceptional person to have on there. He's a non-exec, but just with the financial statements, like someone like that is really helpful. Take Nick French. He was probably one of the main cobalt traders in the world for 30 years. So once again, a non-executive director, but you have a question and you call Nick, and Nick's got an answer for you. So you kind of go through that board. Phil Williams was a banker in Toronto, and so there's a certain advice there on financings.
Right.
Candace, she's an executive at a gold mining company. So you kind of put together this team of experience that everyone has an opinion and they're all different, but everyone has a perspective, which I think is beneficial to the broader board.
Yeah, I guess it says you know what you don't know.
Yeah,
which is great.
The known unknowns and the unknown unknowns.
Exactly. Right. I'm glad, I can never remember how to say that, so let alone understand it. So tell me about the finances, because I want to get onto the share price, because you talked about giving something back to the shareholders. The stock has seen a fall, from this time last year to where it is today, so, about a third. So you need to give them something back. So tell me about the economics.
Yeah, so I think what happened is, in the early days of the stock, I know a lot of retail investors wouldn't have Bloomberg, but I think there's other free sets. If you actually took our share price and the cobalt price and overlaid it, you'd see a pretty tight correlation going up.
Right.
And by the way, cobalt peaks at $44 a pound, and it goes all the way down to 13. It's kind of back at 18 now.
Right.
By the way, our share price would follow it down, the downtrend, right?
Right.
And so I think what happened was, and probably rightfully so, the business was exceptionally correlated to cobalt price and sentiment around cobalt. And I think and hope what is going to happen now is we'll transition away slightly from being just a proxy for cobalt into actually being a proxy for cash flow, right? Because as Highland Pacific now closes on, I think middle of May, right?
Yeah.
All of a sudden there's cash flow there. Voisey's Bay, they start producing, the kind of about 2 years out, like there's cash flow. And so I think you kind of transition away from this binary correlation to the cobalt move, although there is and always will be a correlation.
Yeah.
It's not like you're getting the seesaw effect.
So it comes back to your strategy here, right? What kind of multiples do you get for cash in this business versus mitigating it by buying into actual mining equities rather than royalties, where there's some upside or blue sky potential? I mean, how does it work?
So the large cap names like Franco and Wheaton, they're trading on at certain points over 2 times, right?
Right.
Two times like a P/NAV ratio.
Yeah.
Now, mind you, they're highly liquid names, and the market has changed for smaller cap companies with a premium value, obviously, on more liquid names. That's just the nature of the capital markets today. So I don't know that we would achieve that per se, but certainly trading in the mid 1.5s is achievable. If you look at an Altius, which is a base metal streaming company, I mean, it's a completely different model.
Sure.
But you have to pick kind of comps out there. That's potentially something you could look at. So we think that what will happen is we've initially traded as a complete proxy for cobalt price, but now as we bring in what's really a nickel asset, Highlands, I think what will hopefully happen is a transition away from a binary correlation to cobalt to a more streaming-like multiple. And that will also be, in addition to implying a higher share price, I think that's more stable, right? Like that becomes a more stable valuation as opposed to like a whipsaw with the cobalt price.
And you're gonna stick with that you're not gonna, like we talk about some of the investors, who'll be listening to this either on the podcast or or watching the video, they have a blended portfolio approach. Are you gonna resist that? Or are you gonna just stick with what you know?
No, I think there's no intention to move past nickel and cobalt at this time. We looked at a lithium royalty last year, and the pricing was wrong. We thought it was interesting. The pricing was just not right. And then we also kind of thought it through and realized, there are a lot of options for investors in lithium. SQM, Albemarle, I mean, any number of public companies. Yeah. And so, why buy us over them? I don't know why you would do that. And so I think we kind of really, at that moment, we moved away from the lithium royalty. I think we realized that people are buying us and owning us for that cobalt exposure and that class 1 nickel exposure.
Actually, that's a good question you just asked. So why should they buy you for the
Cobalt
nickel exposure?
Yeah, exactly. And
so what's different about you guys?
I mean, there is no primary. The only primary cobalt producer on Earth is Managem, right, which is owned by the prince and the family in Morocco. There are some exploration companies out there, but that's just a totally different. Every 10 minutes, people are raising capital and there's dilution. And by the way, in the right market, that's a great game. We're not playing that game at all.
Right.
So if you think about it like that, there's no exposure, as it were, to specifically the part of the battery that we're offering. And that's the differentiator. Like, if you want real cobalt exposure, like, here we are. If you want that class 1 nickel exposure that goes into the battery industry, like MCC, that Ramu production, that's going into batteries everywhere. So that's really that leverage that you're getting, which I don't think you can find anywhere else. For instance, if you buy Glencore stock, Glencore is the world's largest producer of cobalt, but by the way, that's probably an irrelevance as compared to their copper business and their coal business. So you're not really buying cobalt exposure, are you? No. And that's where, and even like with nickel, it's kind of the same analysis. Like, look at Norilsk. Well, actually, are they a palladium company now? I mean, based on palladium's run. And so when you kind of go through the options out there, or there's a great nickel company in Australia. I think what is it called? Nickel Mines, maybe. Well, that's nickel pig iron. That's going into steel. So you start kind of going through the options. Like take Giga Metals, one of the largest undeveloped nickel sulfide deposits on Earth. Fantastic optionality. Once again, like, that's a development play. So these are all different, and we're offering something very specific. You're not going to have that exploration upside with what we're doing. This is a very conservative model.
Yeah. So what do you think just to finish off on the shareholder component is, what do you think that's going to do for your share price? We talked about a bit of time to breathe, a little bit of time to give back to the shareholders. If people come in now, new people looking at you, is there going to be reasonable appreciation there? Or how would you describe the opportunity for them?
I don't think like a forward-looking statements could pop up.
Boom.
I think the point is what we're striving to do is transition from this binary cobalt proxy to a streaming and royalty multiple. Right. And if that happens, that's what we're trying to do. If that happens, then that will imply in a lot better share price. And so I don't want to give guidance about what that share price is, but like that transition implies in a better share price.
Okay, so let's talk about a couple of things more about the company, but I want to kind of your view in the market in a moment, if I may. So you had a busy year, a lot of M&A last year, probably a bit exhausted, but what's your report card for 2018 look like? What would you have done differently?
For 18, It's hard to like. It's hard in the business because you can't hedge these liquid commodities. So if you had this crystal ball and you looked at what was really a collapse in the cobalt price from 44 down to 17, you could go back and say, "Oh, we would hedge this or do that," but you actually really can't. And so it's hard to look back. I mean, we raised capital at a high cobalt price, and did not anticipate, frankly, that it was going to roll over as hard and as fast as it did. You wouldn't raise the money at that price in the same way because obviously, there's implications there. But I mean, there's no way to hedge that. So that was the business model. We told everyone what we were going to do, and we did exactly what we told the market we were going to do. So I don't know how you can, other than just not doing the deals, I'm not sure how you can do it because unlike, say, copper, where you could actually hedge it out, with cobalt, it's just not really possible.
Right. Okay. And so, like, you started 2 years ago, share price of
$9 with the IPO.
Right.
Goes all the way up to
12 something.
No, above 1340.
1314. Right.
And now it's kind of mid 450.
Back down. So you're.
And mind you, the very important point.
Yeah.
Is pull up the cobalt chart and pull up our share price chart, and it's like.
For sure. These things go in cycles. But you've got a model which, okay, I think some people have been doing it for a while, but as you say, the royalty business has changed. You think this is cyclical, it's caused by commodity price, things will get better. And you've you're actively saying we need to give something back to the shareholders. That's the message I'm hearing.
Well, it just gives them, I mean, obviously we have a dividend policy and a buyback policy, which allows us to either give a dividend or buy back shares or do both. So that's the give back implies that, which is obviously part of the corporate policy.
Right.
But I think it's also, allowing the transition from binary Cobalt proxy to streaming royalty multiple. It takes time. Okay. And when I say give something back, what I really mean is to try and allow that transition to happen.
Right. But that's a message you need to share, and I guess you are sharing all around the world that we're going through this transition. We know what we're doing. We're in control. We understand the process. We just need to give it that time to get back to where we think it could be.
Exactly.
Is that fair enough? Yeah. Okay. So can we talk about the market?
Yeah, sure.
Because I want you to help our viewers and listeners understand a little bit more about what's going on with in the battery storage space and battery space generally. Okay. So commodity prices are down. Why do you think that is?
Okay, so as you say, and as I said earlier, this is a complete change in these industries. Yeah. And I'm unaware of a single automobile maker who doesn't have an EV planned or already underway. Right. And by the way, this is true in China, Korea, Japan. This is not just like Rover, right? So, so all these batteries are powered by lithium-ion batteries. Right.
So explain what's in a battery for people, just very quickly. Yeah, there are different types of batteries, but generally, what does it look like?
So the main component of a lithium-ion battery is the chemistry. And the main chemistry is a nickel manganese cobalt chemistry. Tesla uses a secondary chemistry called a nickel cobalt aluminum chemistry. It's a higher nickel chemistry.
So what are the percentage breakdowns there? I mean, what's the main
So Tesla today is kind of an 8-1-1 approximately, meaning 8 part nickel, 1 part manganese, 1 part cobalt. Right. The prevailing chemistry for the balance of the world is a 5-3-2. Over time, evolving towards 8-1-1, 6-2-2, 8-1-1. The problem is, as you reduce cobalt, you increase nickel, and the batteries become unstable and can overheat and catch fire. Like a lot of these fires are in part based on the fact that the transition from a high cobalt battery to a nickel-rich battery is complex and challenging. Right. So I actually think the industry has to get there. Like you need that transition to happen because, frankly, there's only so much cobalt out there, and while there's plenty for the coming years, I just think mathematically, if you assume that 70% of vehicles will be electric, well, actually, you're going to need a lot more nickel and a lot more cobalt. You're talking about doubling, tripling the global production of cobalt to meet the demand in 2025, 2030. And so you actually need this transition to take place. But I think what cathode makers, battery makers are finding is getting to that 8-1-1 chemistry safely and with the durable battery has proven more challenging and taken longer than people think.
So you said 70%. That's a big number there in terms of the.
Yeah, that's not like. So I'm thinking like we use like 15% in 2025.
Right. Okay.
But, 70%. I'm just telling you, ultimately, the world will be primarily electric. But you're going to have other. So one of the misnomers here is that like there's only one technology, and the answer is there's going to be different technologies for different segments. Sure. So for instance, I think automobile buses will very likely be on fuel cells. Because a fuel cell is not interesting for cars, but on a fixed route, like at a mine site would be an example. Yeah. An auto bus where everyone gets sent through the same station, potentially a long haul trucking where everyone's going the same route, they stop at the same station. Yeah. Like there's going to be uses for fuel cells, right? Right. Move into battery storage, lithium-ion batteries. Fantastic for things like your power wall at your house where it's light and small. But if you're going to have a massive grid storage installation around a wind farm, frankly, maybe vanadium redox is going to be more interesting over time. Now, that technology is not quite there yet, but there's not going to be one brush to paint everything. This is a complete transformation. Yeah. And there is going to be multiple batteries, including lead acid, by the way, including zinc. There's going to be a bunch of different batteries for different applications. And this actually has implications. I think we're talking about cobalt and nickel today, but this has implications for investors who are looking at the space more broadly through the cycle. And the cycle is going to be like a decade-long cycle. There are going to be moments where potentially lead is interesting, where vanadium is interesting. The recent vanadium run actually had nothing to do with batteries. It was about steel policy in China. But like
Exactly,
people were promoting it as batteries, unrelated, uncorrelated, right?
Yeah.
So a bigger takeaway for your investors is, there are a bunch of basic materials that are going to benefit as this thing kind of rolls out, like copper. 15% of copper demand, 2025, 2030 could be related to electrification more broadly. So this is a big macro kind of trend that's going to impact and touch a wide range of commodities.
So general acceptance in the market, that's where it's going. Is it moving at the pace that people thought it would?
Faster, way faster.
Right.
It's actually stunning how much people don't understand that point. So the Chinese numbers came out, Q1 this year, EV sales up 100% year on year. I mean, I'm unaware of any data point which isn't showing tremendous growth. And I think it's this funny thing, like, have you ridden in a Tesla?
Yeah.
Okay, you have. Okay, so most people say no. So I always find it funny. I say, I'll sit there with someone that say, "Oh, it's never going to happen." Yeah. I've not heard a single person who has actually ridden in one, not owned one necessarily, ridden in one of these cars who doesn't instantly see this is the future. And by the way, I'll tell you something which I know you probably haven't done. Have you ridden in an autonomous vehicle yet?
Yeah.
Oh, you have?
Yeah.
Okay, so when you it's rare because most people haven't, because you have to sign up for a demo. Yeah, so a fully autonomous one, I mean, it is it is amazing. And what you realize kind of 5 minutes into, depending on who's giving you the tour, 5 minutes in, you're like, why am I even driving a car? Yeah. And so it's hard to appreciate that pace of change if, as the average person, you haven't either ridden in or experienced it. But it's sort of like the iPhone, like take the iPhone. You say like, oh, I've got this new iPhone. Why do I need this new iPhone? I got the old iPhone. Yeah. And then, 20 minutes after you use the new iPhone, you're like, actually, this one is kind of clunky and old. Like, you can't quite articulate why. I think it's kind of the same experience, although I could articulate why. When you ride in the EV, when you ride in an autonomous vehicle, then you understand why this is happening so quickly. And that doesn't even get into the effects on the environment. That's just like a practical thing.
What do you think's driving it? I mean, obviously, like with things like the Paris Accord coming in here, and you've got governments signing up to changing the way that their energy structures, are comprised. So, we've got a lot of wind farms here now, which we wouldn't have 10 years ago. So what's driving?
I think it's very simple. Like, we're destroying the Earth, right? Like I don't care, global warming, however you want to spin it. There's all this political narrative around it. The bottom line is, like, we're dumping enormous amounts of plastic into the ocean. We're burning down the forest. Like, all these things are happening factually, right? And I just think that there's a growing awareness of the damage that's being caused to the Earth. I think that's part of it. And so I think people are becoming more socially aware. So that's kind of in the West. I think in China it's very practical. I think in China in particular, the Chinese government has said, look, our people in these big cities are getting asthma, lung cancer, and we need to clean up the air. And there's a bunch of ways to do it. Mm-hmm. But a very simple way is, if you live in Beijing, to say, if you buy internal combustion engine vehicle, it's going to take you 5 years to get a license plate, or we'll give you one if you buy an EV. Those subsidies cost the government nothing. And so I think, in China it's very practical. In London it's very practical. Like, it'd be interesting to look. I don't have my phone on me. Mm-hmm. You would be shocked to know that the London air quality is actually on certain days some of the worst in the world.
Yeah, on the Strand.
Yeah, exactly. So I think governments are acknowledging and realizing the need to clean up air in major cities, and so I think that's another driver. So I think there's multiple drivers here. But what's clear is, if we don't act around our environment, then there's going to be irreparable damage for future generations.
There's a lot more awareness about it. There's, everywhere you look, there's a lot of, and I'd encourage people to read your PowerPoint. Actually, there's some lovely little snippets of information in there. But there's some discrepancy between this generation who are more aware or greener compared to the price of some of these commodities. People aren't investing into mining as much as they did.
That's because they haven't made money. Let's call it a spade.
So there's a discrepancy there.
Yeah, no, but people didn't make money. I mean,
so whose fault's that? Where's the fault lie?
Well, that's a very complex discussion. And there's all these changes in global capital markets with money moving towards liquidity, but mining names are relative, like the total market cap of mining is probably less than a couple of the largest single companies on, like, so there's all these complex things. But if you want to distill it down to a very important point, by and large, equity investors in the big global markets are judged on an annual basis, performance, right?
Right.
What happens to me this year? And that's how they get paid, that's how they're reviewed by peers. Okay, if you dig a shovel and you hit your gold or your copper, whatever you hit right now, if it's ever a mine, on average it's not going to be a mine for 12 to 15 years. Okay, so like you're asking some gal or guy who gets paid based on by the end of December to like take a view on what happens 15 years from now. It's like good luck. And so it's you have this mismatch. You have this situation where it's literally 15 years, if ever, to a mine, and capital's duration today has gone increasingly short. Like it's literally, in fact, I would argue that a lot of the big funds in New York are platforms where like there's daily liquidity. Forget this year. Like their risk departments are looking at things and they're trading today. They're trading by lunchtime, and so it's this interesting dynamic. And then you have a move towards passive, which means that primary equity raises are harder to do because a passive investor doesn't participate in a primary equity issuance. So you have kind of all these forces coming together, and ultimately what it means, I will tell you, and I don't know if that's tomorrow or 7 years from now, like forget the day, it just means it's creating the next bull market. Underinvestment, inefficient investment in the sector will ultimately mean a massive bull market. And it won't even be about, by the way, forget electric vehicles, like we consume every single day. Like look around this room, everything is either mined or grown just about. And so consumers continue to consume every day and they don't recycle everything that they consume. And so because of this inefficiency in the capital market, in the longer term, you set the stage for bull markets and bubbles in this asset class over time.
No, I agree with that. And that's the nature of my question, where there's a discrepancy between what people want and their understanding of where it comes from. Okay, and the same could be said, some of the kids at my children's school, they're not actually sure where the meat on their table comes from because it comes in plastic bags, wrapped, and that's it. That's not a cow. That's just a piece of meat or a piece of chicken or whatever. So, I'm trying to understand, what's changed, or if you've got a sense of what's changed in, say, the last 10 years, 20 years, 30 years for investors. Mining used to be the go-to investment class.
Well, that's because it was a proxy. I mean, if you look at when the market was hot, people were really investing in mining as a proxy for GDP growth in China, right? Basic materials.
Sure.
So that was driving the interest. But also, I think a lot of hedge funds had a lot of different constraints around liquidity. So, in other words, they could invest in liquid assets. And I think what happened in the global financial crisis was a lot of hedge funds, a lot of asset allocators were in really liquid things. Not everything, but a big part of their portfolio was in liquid things. And when you have a cash call, when you have a redemption or redemptions, and you have to start selling stuff, like what you find is like a part of your portfolio goes no bid.
Yeah.
And I just think that completely changed the way that funds were. This is very high level, but
sure.
It changed the way that funds were structured. And so now a fund who maybe in 2005 could have 15 of his or her % portfolio in a liquid assets, maybe today they run 1%. Just made up the number, right?
Sure.
And so by the very nature of mining companies, you're at $1 billion market cap, $1.5 billion market cap in mining. Like actually, that's a big company.
Yeah.
By the way, that is completely irrelevant in the spectrum of daily liquidity. Like these funds now, they want to have a $100 million position and they want to be able to sell out of that in 2 trading periods. And that doesn't exist in mining. And so it creates that inefficiency, whereas a decade ago, or maybe longer now, those constraints weren't there.
Yeah, well, there's definitely been a move away from exploration, I think, from some of the institutions.
Yeah, but I agree with that. That's gone because that's too binary. But that's different than liquidity. I'm talking about.
No, I understand liquidity, but the knock-on effect is, and for a lot of the people, certainly the investors in the junior mining space here in the UK, there wasn't the liquidity for them wanting to get out of $1 million positions. Forget $100 million, okay, because things weren't moving. There's no volume there. So that's had a big knock-on effect in the way that juniors, certainly in the UK, and then we see a lot of Canadian companies coming over here hoping to find some money. And there's more of a reliance on this retail, high net worth family office type money for the smaller. You're a pretty big company now. I know you still.
Look, retail, there's a place for retail because historically, the way it's been is like retail, friends and family. Retail was the early money.
Yeah.
The stock would run, and then hedge funds would step in. The stock would run again.
Yeah.
Institutions, and that was the plan.
Yeah.
Look, it still happens from time to time. But that system has been slightly disrupted by a change at the bigger end of the street.
Yeah.
I still think with retail that you can make money. Remember, by and large, even in what we're calling illiquid names, $5,000, which is a real amount of money. My dad's a high school teacher. My dad's a high school teacher. Like I could tell you, for him, that would be a huge position.
Yeah.
There's sufficient liquidity even in like our stock trades, $1 to $3 million a day.
Right.
So a $5,000 position you can kind of come in and out of. Yeah. But if you're in a name where you're going to build a mine with a $1 billion capex, I'm just making a number up. Ultimately, the big guys are going to have to write a check, and I think when you're a retail investor, you have to think about that question. Like, unless you're just taking a punt, which is fun and everyone does it from time to time, but if you're saying this is a longer term investment, like you have to think that the stock is going to re-rate. So at the next capital raise, it's higher than when you came. You're going to have to think.
That's the name of the game. We're buying shares, not the company.
Right? Exactly. And so you have to think that ultimately there's a path towards that big capital raise and becoming a mine.
Absolutely.
And that has been completely disrupted. And that is, I think, going to result at some point in the next decade in big asset class bubbles in our asset and big bull markets because the pipeline is not getting built. Like look at nickel. Okay, if we all agree, and I don't know anyone who disagrees with this statement, that we're going to need a heck of a lot more nickel in 5 years. Like I literally don't know a single sophisticated person who disagrees with that statement.
Right.
Not one. Okay, so what's getting built right now globally?
Yeah.
Like the answer is not much.
And that's the same for a lot of commodities at the moment. Because
copper is the same way to
right?
a T. But then this comes back. It's all circular. It comes back to my point. So let's assume we agree. Well, you're an investor. You get paid by year-end December. Yeah. I'm talking at the big end of the market now. Like you can't be bothered to think about 5 or 6 years now. Like because you're really worried about having your job this year. And so it's creating this weird moment where these projects aren't getting pushed along. And so we're going to wake up and it's going to go kaboom on some of these commodities.
And it's really interesting actually because if I'll just an example here, UK politics, we vote every 4 years and decisions by politicians are made on a short-term basis. If we look at the Japanese government, they're making decisions 25, 50 years out. There's a very strong difference between the way that politics works, seems, for the greater good or for yourself.
Look, last week China just put a few $100 million more into Ivanhoe, which has this huge copper deposit in the DRC. Why? Because they know they need copper, right? I mean,
but what happened to the ethical component we talked about earlier then?
Well, I think that's different, right? Because that's a development project.
Right.
And when you're developing your own project, you can control those parameters.
Right.
So that's not there's no artisanal mining there. That's developing probably one of the largest copper mines on earth.
I mean, okay.
So that's different. But my point is, so what's interesting is China has, because I don't begrudge the investor whose job is what their job description is. Like they can't control that by and large.
Right.
Because by the way, they have their own set of investors who are demanding that liquidity.
Everyone's got a different business model.
Right. And so but China, where China has a unique position and stage, kind of seat at the table as it were, is that they're able to say, whatever, like we think copper is going to happen, so we're buying the copper mine. And that's going to have big implications on the fourth industrial revolution, which is underway.
Yeah.
Because if we all agree EVs are going to happen, but not just EVs, a bunch of things like renewables and all these other things, those are all powered by somewhat esoteric commodities, and China's going to control all the major deposits. And so government. So it's really smart.
No, I think they're fantastic. I think they're fantastic. In a way, they kind of control price in that way because they're price insensitive to a degree.
I would say yes, no. I mean, I can tell you we're there a lot. These are people. That's a misnomer. They're not just spraying money out. They have a very sophisticated process. They still think about NPV. They do think about the greater good as well.
Right.
But I can tell you, there's no free ride. Right. That's not true.
Right.
They're still.
That's why I said to a degree because I think their tolerance levels are more than most.
They can look through cycles, is what I would say. Okay. So the one of the big differences is that a Chinese investor on a world-class project can look through the cycle, whereas an investor sitting in New York very much is concerned about the cycle and trading around the cycle, and that's a fundamental difference.
Well, like you say, that's the difference between a daily trader, a day trader, versus forward planning.
I'm not calling U.S. investors day traders. I'm just saying it's just a different. I'm just saying it's a different model.
No, I understand. Can we just quickly touch gold? I know it's not your thing, but you're a finance guy. You've got experience in this thing, and it comes back to the discussion we've sort of been having now about sort of sentiment in the marketplace. Gold has traditionally been safe haven, to use that well-worn phrase, for investors in troubling times when the world's at war, or there are trade wars in this case. That's not happening right now.
Yeah,
it's not moving.
Gold is interesting. So I'm of two minds on gold. Of two minds on gold. First of all, I challenge you to find a gold bug who is under 40 years old. There is not one that I'm aware of. And so I think you actually have this age problem with gold where there's not a new kind of group of investors who are enamored by gold who are under 40. By the way, those happen to be a lot of the PMs out there. And so I think there's just this element of crypto and some other asset classes have supplanted gold. Now, but mind you, on the drop of a hat, it can all kind of come back. But I think that's part of it. I do actually think though that gold is interesting from a different perspective. With the weaponizing of the U.S. dollar and with these big gold purchases by the Russian and Chinese government, you can see, and also China's trying to redenominate crude and some different commodities in the RMB, right? So this is all a big strategy to say why should the U.S. government have visibility on every SWIFT transaction in the world? It's like that, but this is a 20-year thing.
Sure.
And so it's very hard to read in, I think, on that basis, when gold actually is going to become interesting. I'm not negative or positive. I'm just saying that that's a big macro change, which is going to roll out over 20 years. I also think at some moment, we've had unprecedented in modern history printing. At some moment, the U.S. will slide into a recession. No, I'm not saying end of the world, just a typical business style recession. They're going to try to print at some point inflation. I'm not a gold bug. I'm not a hyperinflation guy, but inflation comes in and gold becomes interesting. But I find that cycle is so hard to call that I can see it. You can see it kind of from 100 miles away.
Sure.
But you don't quite know how fast the car's going to get there, right?
But there's the point. You just used a great phrase. It's no one can see when it's coming. You can apply that to uranium, gold, copper,
commodities.
Nickel, commodities.
Yeah.
And that's, I guess, the
gold is slightly different because like cobalt is highly driven by a supply demand model, highly correlated. Gold, I don't know, are Indian farmers buying gold, and what is the supply? I don't know.
Sure.
But so I would argue that base metals and gold are differentiated on the basis that a supply demand model really impacts your copper view.
I understand, I'm trying to wonder if the sentiment applies across commodities as a whole, irrespective of whether it's an emotional purchase like some of the precious metals, because people, as you said earlier, people are viewing it differently now. People under 40 are viewing it differently now. There's stuff which we're going to need to build the stuff we want to use every day, and at some point people are going to have to wake up to the fact that, as you say, there's going to be a bull market. There's going to have to be a bull market because there's not enough mines in production producing the stuff which people need to be able to produce the things that we use every day. So people will wake up to it, but I'm not sure why we can do this.
They're not asleep, but let me be clear. On the base metals, when you go through New York, the fund manager, they're all really smart, intelligent men and women, right? Yeah. So they can see the same thing I see. It's just their structure of capital dictates their investment horizon, okay? So it's not like that, one day magically copper is going to run and they didn't see it coming. It's going to be that, they think it's coming in 24 months, and so let's get in 22 months. I just made that up, right? So that's different. Whereas gold, I don't think you can have that view as much because probably it is coming, but who, what, when, where, why is much harder to predict when you don't have a supply-demand model informing you, in my opinion.
I guess the point I'm trying to make about institutions, they've got to make decisions. They're about making money, right? So they set up structures, and if we're saying they're not nimble or flexible enough to change, to adapt, advantage of a situation.
But why would you invest in gold? I mean, what's the S&P return right now? 20% this year?
Not necessarily. No, I wasn't talking about gold. I'm talking about the other commodities which are lagging. Like, you know,
I'm going to play
right?
devil's advocate. Why would you invest in commodities this year or the last few? I mean, this you show up to someone, right? You show up to a lady in New York and she's running.
Yep.
You know, they won't like the funny joke here for the retail investor.
Right.
Like when you're in New York, if they don't tell you how much money they're running, it means it's less than $10 billion, right? Because when you show up, they're like, we're running $100 billion, right? So, like, why does that individual who can invest maybe in anything care about kind of a sector that's underperforming Apple and Amazon? Like, why do they care? You know, like, I mean, you're trying to get them as a company. You're trying to get them to care. Like, we had a moment of caring because of the adoption of electric vehicle.
Yep.
But if you talk about the sector more broadly, you know, they can invest in anything they want. And frankly, a lot of this stuff has massively outperformed basic materials, which, by the way, in addition to having underperformed, is also kind of a liquid and kind of hokey, and not all the management teams are that great. So you know, if you think about it from their perspective, you know, it's not time. And you know, there's an argument that it becomes time when that market's fully invested. Maybe some of the money flows down. But I often suffer from this, and I think a lot of investors who focus on mining suffer from, like, you know, missing the forest for a tree.
So are you saying people are institutional and retail have just got smart to the game played in the mining sector?
I'm not calling anything a game. I'm just saying that there's been a lot of other opportunities which have materially outperformed. You know, like look at Yeti. I just say that because I bought some Yeti stock. I think it's doubled this year. You know what I mean? So, and by the way, it's liquid. You know, like start naming these stocks. And so I think, you know, if you're an investor,
you got choices.
You got choices, and like, that's just a reality. And we should not pretend like
I say it all the time.
You know, all the time. So, you know, and I think one of the things that we're trying to give people the choice is around an EV proxy adoption, but talk about the industry more general. Like if I'm Anthony and I can buy anything, like tell me, why should I buy your gold company over Apple stock right now?
Yeah.
And the answer is maybe I shouldn't, or maybe I should. I don't know.
Yeah, I mean, you could have a long-term view about the commodity, the sector, and all of that.
A long-term view. So, okay, like I'll play devil's advocate. Okay,
yeah.
Okay, great. So you're telling me gold's going to run in 2 years? Well, great. I'm going to own Apple for 2 years, collect my dividend,
and then invest.
And then I'll buy gold. And that's kind of that's what you're facing. Like, because I talk to these investors all the time.
Yeah.
They say, Anthony, so is this happening? When's this happening? So I don't know. Well, that's great.
Yeah.
I'm up 20% of the S&P this year. Like, let's talk when it's going to happen.
I mean, it's maybe a discussion for another time, but then that leads to issues for, again, some of these companies who are struggling for cash. You know, it's a self-fulfilling prophecy in a way, right? But it's great for companies like you. But like I say, conversation for another time. Yeah. Look, let's finish up here because I want to ask you about, well, without forward-looking statements, I want to ask about this year. You've sort of explained that earlier on, but maybe talk about deliverables or focus for this year or the next year.
Yeah, I think for the balance of the year, it's about closing the Highlands acquisition, getting everything kind of in place, and really, you know, making sure that everything is buttoned down. Having done a bunch of acquisitions, and then hopefully having the cobalt and nickel price come our way a little bit, so that you know, we get a bit of a re-rating, not only from the underlying commodities, but also from this transition from you know, being what was initially a stockpile to now being really a streaming and royalty company.
Fantastic. Okay, we're going to finish off. Give me 5 reasons why people should consider investing in Cobalt 27.
It's simple. We're a proxy for the adoption of electric vehicle, and I think there's no one else out there doing what we're doing.
Going with one big one.
That's the big one.
Okay, fine, brilliant. Hey, Anthony, thanks very much for your time.
Thank
Lovely to meet you.
Cheers, yeah.
And we look forward to catching up with you again soon.
Cool, anytime.
Brilliant, thank you. Thank you very much for watching our video. We do aim to give you informed and intelligent information with which to make your investment decisions. So if you liked what you just saw, please give us a thumbs up. And if you want to see more insightful, in-depth, honest and unbiased interviews, then please click the subscribe button. So thanks again for watching, and we look forward to seeing you again soon.